Hello, everyone. Thank you for watching the Mortgage Leadership Outlook. I'm Andrew Berman, your host, coming to you on this about to get really crazy rainy day here in New York. We're about to get torrential downpours. So if we lose power, I got my battery back up, ready to go. So we will not be stopped. Much like this mortgage industry will not be stopped. I've had actually, so one of the cool things about actually this, the pandemic that we've been going through is we've got actually this cool app that's come to us, Clubhouse. Hopefully you're participating in it. And through it, I was able to connect with someone I've known for a while who actually has been featured in our magazine, who, is just a legend, and happy to have him on our show. Robert Pieklo, thank you so much for joining us, Robert. Really appreciate it.
You led right in with the wrong. It's the K before the L. It's Pieklo, but we're good. I know you practiced it the whole time. I sent notes. I sent everything, and you messed it up.
I just totally
within a minute.
Oh my goodness. But
you made up for it by saying legend, so I do appreciate that. Far from that, but yeah, thank you very much.
No. You are a legend. Let's actually call it because I've listened actually to your the way actually you control the room in Clubhouse. It's phenomenal. Your insights, your excitement about the business. So I want to ask you because I've never really asked about this. I know you go around talking about this just the mortgage guy moniker. I want to let's dig right into that because I want to understand what the hell that means. And by the way, if you're just catching us, thank you for joining us. We're going to talk about margin compressions, the value of the mortgage broker, talk a little bit about channel conflict. And there's, of course, I got to ask about, what possessed this guy to buy into a large mortgage company when, in 2008, when everything seemed like it was a bad time to get into it, it paid off really well. But first off, just the mortgage moniker. What is that? Well, tell us a little bit about what that is.
Just the mortgage guy. So it's funny. It kind of comes from my roots. My roots as an originator. I started in the business as an originator, and it seemed like for a few years there in the middle, I was I hate to call it not ashamed of it, but it was the mortgages. The industry wasn't looked at favorably. We went through a lot of different talks with different people and investments, and going through that whole kind of figuring out where to get capital, how to get capital. And I want to say I got a little bit removed from being a mortgage guy, being the mortgage guy. And yeah, I feel like I know the business. I know a lot of pieces of the business. And I don't want to call it just a mortgage guy to make mortgage people feel bad because that's what I am. But I was trying to be more than maybe I was in my career. So I really enjoy the business. I feel like I'm an expert in that business. And I wanted to bring it back with the new company that we started and the origination channel that we're in, to bring it back to being just a mortgage guy. It's what I know the most. It's what I've been doing for my whole adult life. And I wanted to kind of use that moniker, use that kind of hashtag out where, maybe someone looks at it and says, hey, he's just a mortgage guy, but I do know the business well enough. And hopefully it can educate other people that are in this business, because I am now in the front lines and we're back in the front lines. And I'm hoping to kind of give some of that corporate world, that back office world, that raising capital world, the MSR, the Ginnie Mae, the whole securitization world, all of that, and bring it up to the front lines through being just a mortgage guy.
So now, what? So does that mean actually do that for the borrowers and educating the borrowers about actually the whole process? Do the borrowers really care about about the servicing side of the business? I mean, is there actually that the borrowers that you work with? Is there that much of a thirst for knowledge, to really understand how the sausage is made?
No, they could care less. They're like, just close my loan. I want to buy the house, right? That's like, please, I want to deal with all this stuff.
Where do I have to sign?
Yeah, it's more so for referral partners and people in our industry. So when they see it, and most of the things that I do, like if I'm on Clubhouse, you mentioned earlier, if I'm running a room in Clubhouse and we kind of get in depth about the business, and I want people to ask questions and try and understand how this works from a say more of an industry insider standpoint. So from a borrower's perspective, they like hearing or like being referred to someone that seems to know what they're talking about in the business. You're going to get not a ton of that in our business in terms of knowing how the whole thing works, but I certainly don't try and educate them on how how their loan's going to turn into a security and get spliced and diced and sold out to an investment bank. That's not part of what we do, for our education purposes. But we do let them know that, hey, by the way, we've also I've had been in charge of thousands of people that run divisions and have seen, thousands of loans per month go through my desk, and now you're getting that experience on the front lines.
So the borrowers, it's more like I guess vanity so much. Just gotta say, hey, just so you know, I have this actually experience behind me. It's more about the referral partners. I'm assuming recruits, the people you're trying to recruit, loan officers. They want to know that the partners I'm going to work for are actually have their experience. They're not just actually salespeople that just have decided to actually become broker owners, but they're executives with decades of history. So let's go into a little bit of that history. So 2008, you had mortgage experience prior to this, but 2008 comes along, and here you go actually saying, all right, I'm going to buy into this AFR, this company that, and I remember 2008, I had actually a friend of mine introduced me or mentioned AFR, where it was scrambling around trying to find wholesale lenders as they just kept dropping like flies. I remember actually in 2009, we came out with our, we now call it Who's Who in Wholesale. It was actually called the Who's Left in Wholesale. It was just this sad actually list of companies.
Exactly.
But one of the companies, sure enough, actually, that we were trying to target at the time was AFR. So 2008, tell us about the opportunity, that you've seen, actually, that you saw in 2008.
Yeah, I mean, the AFR and my AFR family, it was amazing, right? So I started there in 2003. There wasn't too many of us, 14, 15 people. I mean, we were in a small little building. When you literally, if you had to use the restroom, you'd hit the CFO's chair when you open the door. It was like one of those small shops. So it was really cool. And in 2007 going into 8, we were just getting our Ginnie Mae ticket, and wow. I knew nothing about securities, or I hadn't run capital markets or anything. I was running a little sales team at the time, and we were getting our Ginnie ticket. But if you looked at kind of the landscape and where things were going to go, I anticipated that Ginnie was going to be something that was important for the future of the mortgage industry, at least short term. 2000, well, going into 8. So we were just getting the approval process going, and this was a lot of chaos going on and people dropping out left and right. So one of the partners there was getting out, and an opportunity to buy in. So I had to beg, borrow, and steal every penny I had, which is an awesome conversation, right? You come home to the wife and mother-in-law and be like, hey, by the way, I'm going to take everything we own and we're going to put it towards this mortgage company when the world's blowing up at that time. But we had that ticket, and the story is the story, right? There was a handful of issuers. Many of them weren't issuing anymore. We got our approval. They basically closed the door behind us for our Ginnie issuance approval. What was a 3%, 4% market share turned into a 35% market share because of the subprime crisis and all those loans going away. So it turned out like we were positioned really well. And I'll give credit because, I mean, the company itself and Rich Dubnoff, the CEO, and the decisions he made, maybe we were complaining about them at the time, where, no, we're not doing these, we're not doing these teaser rate loans. We're not going to be, doing all these ARM loans. If we do anything, if we work with any of these guys, we're going to buy out the rep and warrants because there's, and it maybe costs 3/8 in price. And we're like, oh, we can't compete if we have to pay 3/8 to buy out the lifetime of loan, rep and warrants for that. And meanwhile, he's such a genius that he kind of saw the writing on the wall, and we never really got involved with that. So we were in a position, being a company that we were at that time, to really take advantage of having this Ginnie ticket and grow because of the market share growth. And then we had some great people on the team, but we became a bigger company and a bigger wholesaler right after that, and got to keep our own servicing and move forward that way. So it was tough conversation to have when you're ponying up all the dough for it, but it was obviously one of the best things I ever did in my life. And that experience that I got in AFR from the start through and getting to run capital markets in 2010 through 2015, run strategy, open up a consumer direct brand. I got to do some things that I probably didn't have the skill set to do, but I learned it quickly. And the team there just gave us so much experience and gave us so much so much leeway to help grow and learn the business, and I'm forever grateful for that.
Of course, here we go. I'm going to throw this up on the screen. There we go. 2013.
Bad hair day, but yeah.
Yeah, very cool. That's the 40 under 40 from 2013. I just happened to digging through the archives.
It's around here somewhere, and it was funny because that at the time I just crested, so I'm no longer eligible. I was just telling you, I'm no longer eligible for that. But yeah, it was awesome. It was a great thing to have, and thank you for that at that time, and thank you for bringing up that terrible picture. But that was my headshot for a while too. That was my headshot for like 8 years. I was like one of those realtors out there that had this glamour shot from 20 years ago.
Of course, yeah. My photo that I'm using is like from, I think, about 5 years ago.
I think yours is high school. No, I'm just kidding.
Yeah, it's my bar mitzvah picture. Actually, it's the suit still fits, so why not?
Exactly.
It's great. So, all right. So one of the things like that I really actually enjoyed, participating. So, and this is something you've talked about a few times, actually, in the Clubhouse. Mm-hmm. Is what actually you would do to kind of advise mortgage companies to get through the coming margin compression they're already in right now. So and you shared actually some of the tactics that you did over at AFR. So talk a little bit about that, because and if you could share actually how real is margin compression for our industry today?
Yeah, I mean, if you look at it, I guess in a percentage basis, we've just had an incredible amount of compression, right? But we were coming off of record highs. So if you take a look at what people are doing in terms of primary to secondary market spreads, if you take a look at, basically, if you just look at a rate sheet every single day and just do those comparisons, you can see that things are getting a little bit tighter. There's a little bit less volume. Now, we'll see what happens, because we were moving on up, and then all of a sudden we had this little pullback, the 10 years in a spot, and we're mortgage people, so we forget quickly what 1 month ago was for submissions. But we talked a lot about kind of how it looks in terms of operational capacity, where we are in service levels, where we are in staffing levels, and then there's a certain amount you can go in terms of dropping margin. A lot of that's gone away. So mortgage companies had a choice at that time when they were making 300 basis points, 275 basis points, and they can kind of stay there at that level and kind of see what the inflow of loans are going to be. And you wanted to monitor that inflow of loans. And as those things start to dry up, then you can move down. And people had a choice. There was some active margin management. You would wonder why you run a regular conventional loan and see a delta between maybe the best priced lender on the wholesale side and the middle of the road one was 150 basis points. That's more than anybody was making in 2019, 2018, 2016. So there was that delta in those loans, and you just saw some companies out there were just choosing, we're going to stay kind of a little bit larger, a little more robust with our margins and make a lot more on those loans, where others go a different route. And I saw this when I moved from AFR to DiTech, and you started concentrating a little bit more on that operational cost and really focusing in on that cost to complete. And you heard me talk about that a lot on Clubhouse, is that something, it's a metric that everybody's kind of looking at. Without a lot of loans, your cost to complete starts to go up a lot. And if you have that larger cost to complete, it's like that baseline of what you need to make on every single loan. So a lot of people wonder, well, why would a mortgage company go out and maybe not make as much, maybe only make 30 basis points on loans for a while? Well, it's because you're driving the overall cost of their loans down. So you can see that the more that comes in, the more you get to divide that bigger number and that cost number, because you know how many fixed costs that there is in any business, and the mortgage industry is like this. So it's even harder to try and manage those fixed costs with the volume levels that go up and down. So you really want to pay attention to kind of that operational cost and have that, what a lot of companies don't do. I call it lazy secondary and lazy margin management, where they just go, oh, we have a lot of loans today. That's too many loans. Let me just slap 40 basis points on everything, versus really concentrating and looking at what you really want to bring in and making margin adjustments for the ones that are taking too much time. So we did that at DiTech a lot. We looked at what kind of loans we wanted to bring in, and then we would adjust margin to even one specific type of loan that we knew would get through a little bit faster, or something that maybe wasn't as coveted that we thought was a better product than what other people were thinking or pricing it.
So was there like an opportunity that you would see consistently arise when you're like, okay, let's look at this particular product that seems to be always a place actually that we've got a little bit of room that other lenders aren't maybe paying attention to? It
was probably more the other way around, where it was like we were looking at some things where we went, well, we can't really compete when let's say at AFR, when we didn't have like a big REIT structure in the capital or in the MSRs we were acquiring through our wholesale division and our correspondent division. Those things were, if you looked at that amount and the cash outlay that we had, we just couldn't compete with some of these guys with a REIT or something, some other mechanism, maybe has a much higher value for their servicing. When you're using a sub-servicer, the actual cash inflows that you're receiving on servicing aren't as much as if you have your own servicing in large scale. And so you have to kind of look at those and know, like, all right, well, today I'm not going to go after that perfect borrower and in my margin because I would have to go underwater 20 or 30 basis points. Now we're willing to not maybe make money on a loan, but we're not willing to lose money on a lot of loans to get that in, to get our numbers driven down. So it was more about what not to go after. And we always found, at least at AFR, we were more of a niche type lender, and we loved the kind of high touch loans that had margin and kind of withstood waves like this. And if you look at AFR's volume, it's always been very consistent. And that's kind of our thing. Like we found in 2011, 12, that HARP was going to be something that there was an incredible amount of value. So we went through those type of products. And then when we went through compression in 16 and went again and I wasn't there in 19, I was at DiTech at 19, we looked at some of the loans that people were doing and how aggressive they were getting prices. We just took a step back and said, we're not going to do those types of loans. We're going to look to get into other space. DiTech was a great example in 19, really focused a little bit more on government loans and where can we find in the market that some people are undervaluing, specifically around servicing values in government loans. And we were right. So we were able to make some really good trades there.
So any particular niches in government loans? Is it like, the low FICO score? Is it, renovation government loans? Like what was,
yes. And yes. Yeah. So it was, so we found there's different anomalies and how the stuff breaks down, maybe not for this call, but just in general, at AFR was definitely the renovation loans. So the 203K Govy loans and doing manufactured homes was amazing. What an amazing product that they did. And they did a really good job with it. And then obviously one-time closed construction loans, which is what they're known for as well. They found great relationships and ways to get those things done that other people couldn't do. So those high-touch loans were always kind of the bread and butter for AFR. And it was good. It's tough in the secondary market in terms of kind of what we would do because we didn't have as much volume as others. When you have a lot of volume, you can do different types of trading and other type of spec pools. We didn't have a ton of that, but that product was really good. It was lucrative, and they did it right. At DiTech, we did find buckets, right? We found really good buckets of FICO buckets in government where we focused in on that. We focused in on getting as much servicing value or much servicing fee we possibly could because at the time the coupons weren't trading necessarily the same as servicing was. So we saw incredible value there and brought in a lot of government loans, especially where we were able to keep excess servicing within our Ginny servicing portfolio. So we found that, and that was kind of how we combated what was going on in the market at the time.
So what about today? I mean, it's still same rules apply. Is there any particular product opportunities that you see where as we're going to as we're facing the profitability cliff?
Yeah. So I'll be honest. Right now, I am so interested. I'm glad I don't have like that many loans to worry about being a small company that we are in origination side. Like we're reaping the benefits of this kind of war that's happening out there. But I'm interested to see what happens with the public, with all these companies going public and new access to capital. So you got to remember the mortgage industry had a few players that were in some kind of structure that was public, but they never really were huge players in the market outside of maybe of a PennyMac. Everybody else who was public was like much smaller, maybe doing some specialty loans that are out there. Now that you have this slew of people that kind of rush to the public markets, what's that going to look like? Because in the mortgage business, there was this, give and take about it's not just making money, it's about the actual liquidity and how much hash does it cost to generate an MSR, and if you are retaining servicing and how much it costs for advances and all these fun things that you have to deal with in the mortgage space that a lot of people on the front lines don't get to see. But when you're going down the manufacturing process, there's a lot of cash outlaid. So it's going to be interesting to see what this looks like, because the last time there was pricing wars and margin compression and kind of what you see, these companies weren't public.
Yeah,
these larger companies weren't public, and now you have so many of them public. We want to see what this is going to look like, and I'm hoping the right people. And I said this back in 19, I said it back in 16. Is that like when you have these little spells of this, the people who win are really the smaller companies on the front lines, because they're getting this incredible pricing opportunity. They're not dealing with all this cash and back and forth. We get a rate sheet, you look at it and you go, whoa. Wow, that's really aggressive, and DiTech is a great example because I talk about this all the time on Clubhouse. was that I remember coming in, and this was like, I barely knew UWM. I knew of them. I just didn't know that they were obviously gaining some steam, and they were doing volume, but they were just a competitor in the wholesale space. But we looked, and I remember someone like emailed me something like a screenshot of rate sheets or something like that, and we looked at it. Now I looked at the pricing between them and Quicken, and it was better that I could get than if I had my full execution going to security with spec pay ups. I wasn't getting as much as if I was a broker selling one loan, the Jones loan to or originating on their behalf, one loan, and it was paying better through the wholesale channel at that time. So that like goes to show those were private companies doing it. Now that they're public, does that mean they're going to get more aggressive or less? I'm just curious to see what that looks like in the next 6 months.
Well, so listen, maybe before actually, we had the ability to go to focus on production, and that's it's production because that's what you want to show. You want to show revenue. You want to show revenue. Once you go public, actually, then actually, you want to show profits. Yeah. So now what happens is now actually we have to expose every quarter, okay, this is what it cost us actually to originate. And I know actually, second quarter 2020, it cost us a lot less than actually that it did cost us in 2021. And now all of these bodies that we buried, previously are there exposed because they have to be full disclosure. It gets me nervous. It's like, so as the earnings are starting to come out, going to be interesting to see what where the future value of these publicly held companies, and it's a transparency that we've never seen before.
It's going to be interesting. So there's two pieces to that, right? So it's more than just the one side of it about profitability, because you're going to have this move when rates move up. You're going to have your entire book of MSRs and that value go up. So on terms of a GAAP accounting basis, you're going to see like some noise in the quarters. They're not going to show like the cash on cash. You're going to look at it in terms of, well, the whole portfolio went up and they divided by the whole, all the volume that you originated, but that MSR book is going to move. So the companies maybe have some opportunity that maybe if the originations or the revenue from Orig is a little bit weak, the servicing side should pick up because those things are all going to go up in value. What's going to happen is that doesn't continue as rates go up. There's a certain cap. The MSR is only going to be worth a certain amount. It's not going to just you can't just keep multiplying and multiplying it, because at some point the loan's not going to be around for that long, a certain cost to service. So you're only going to multiply it by 4 or 5, maybe a max 6 times for the servicing value. Once that has been maximized, and we're getting close now, once that's maximized again, you're kind of hitting that peak. Those are the quarters that you're going to start to see where, you talk about kind of what's hidden. And boy, like 350 basis points of margin can hide some incredibly inefficient processes, right? You're going to see some operations that maybe aren't going full pull. There's plenty of companies out there that we know that, especially on my side, looking in, being just a mortgage guy and getting to deal with these people and processes firsthand. I know that there's plenty of companies that have gone public that don't have efficient operations and have like some of the most inefficient operations that I've ever seen in our business. They're doing tons of volume, don't get me wrong, but they're throwing people power at it, and you can hide it because they're making so much margin. Well, that's gone. So it's going to be really quick to be exposed when that comes out and you start to see, some of the numbers. And like I said, you'll probably get masked with some servicing values going up and you'll see that kind of be hidden. But then that next quarter should be very interesting, or the following one for those that have those inefficient processes.
Yep, those companies actually who spent the money hiring people rather than using technology to address actually an automatable process.
And you'll be surprised that, there's a lot of them that did it, that just, hey, look, like this is a little bit of a whim. We're not going to, like, it's typical mortgage mantra, right? Like the mortgage people and folks and executives, like, when things are really good, we're too busy to implement something new. There's no way. Like, oh, look how many loans we have. Why would we change anything? Like, we can never implement this. We'd ruin the process. Let's just keep plugging away. And then, because it's the mortgage business, it doesn't like slow wean it. The switch gets flipped, and it's like, whoa, we have no revenue to pay for any technology. So you can't find that like slow and if it just was like slow and steady, and you went from 55 basis points on the 10-year to 170, whatever it hit last week. I know it's at like 155 now, but if we had that over like a year and a half and this slow progression, maybe then there'd be some investment in some of these things. Now there's companies doing it. Don't get me wrong. There's some that are doing some investment, but you'll be surprised. There's still plenty of companies out there on our side, huge companies that are like fillable PDFs. Like, could you imagine? It's 2021. I have to print out a PDF onto my desktop at least, type in the loan information of that company, that one I'm staring at in their portal. I pull down the document from their portal. I have to read the loan number, the address, the loan officer, all the stuff that I've already given them. I have to type that into a fillable PDF to tell them their own information. That's happening in 2021 with major lenders.
Wow.
I'm filling out fillable PDFs. Holy cow, it's 2021. We would not expect to be doing that in the mortgage business. I actually thought by now, if you interviewed me in 2014 when I was doing the 40 under 40, I would have said by 2021, we would be, 2 clicks on our phone, and we would actually maybe be like a Rocket commercial, not like the fake, way it actually works. But we would actually be walking around with a proactive mortgage wallet on our phone. But we're not there. We're light years away from there. We spend too much time and money on like TRID and new applications and all that other fun stuff that we have to deal with.
Yeah, but it's ridiculous because all the information is out there already. To know actually whether a borrower has the money, has the income, has shown actually the ability to pay, shown actually the willingness to pay, and that the collateral actually is there at what they hope it's going to be. It's already out there. All of this data is out there, but we just have, besides actually the regulatory part of it, we just have this just cumbersome system with islands of data where if we manage to get it closed in 12 days, we're popping open the champagne.
Yeah, it's what's celebrated in our business. If you take a look at some of the LE insights and see the data and timing it still takes to close a loan. Again, you say insights for the mortgage business. I call them mortgage rants, and I'll just go on these rants where I'm just complaining about timing and like, if we're so sophisticated and technology is so much better, why does it still take so darn long to close a loan? That I don't know. And you'd be like, well, purchases you have to wait for the seller, blah blah blah. Well, how come on refinances it still has to take so long? And how come on refinances sometimes that don't even require any income or asset documentation or an appraisal, how come it still takes 30, 40 days based on Ellie's insights? Like, you wonder, you're like, well, maybe the process is broken. And it is. It's fragmented data. Everybody has fragmented information, and creating something. I've said it for a while that if I was a company with the amount of people that have moved to the wholesale channel, if I was a company in our space and I knew all I had to do was create a platform that has on-demand disclosures, that you can get a pretty easy approval, easy to upload conditions, and then be able to deliver a in-process CD, which speeds up everything. If you can do those things, you would have an incredible, you wouldn't know what to do with the business you would get based on how many people are now on the front lines of origination. And there's only a couple people out there right now that have that. And obviously they're the major players in the wholesale space.
So now, is this a plan, that you see for Equity Home Mortgage? So here you are. You've had, tons of experience, as a mortgage banker, successfully, part of AFR, which is just a phenomenal success. The way I look at it, especially where it came from in 2008. What made you pick the mortgage broker platform? And do you see the opportunity to be able to execute this process the way you talk about it in a mortgage broker platform?
Yeah. Do you have capital you want to send my way? I can do it. No, it's the, that part of it is, yeah. So to start, the whole point of this, so I was starting my own company and kind of one of my other partners, my old partners at AFR, was starting a company, and I had started a company, and he was just kind of getting going. And I don't know, it was like February, the kind of COVID was just getting rumbling a little bit. And we were like, maybe we should, and we've been best friends for so long, maybe we should partner up. And that's what Sean Hammond, and our families are close, everybody's close. We said, you know what, let's partner up. Instead of me running an independent company and you running an independent company, let's just combine forces and do that. And the first part of this was because he wanted to just originate and just do some loans and get a couple people to work with us, and that's it. And for me, really, the plan was to get into the space and learn it again, right? We had to relearn it. And because I think I know everything and I'm going to be good at it, I said, oh, this is going to be a 3-month process. Holy cow, it's not a 3-month process to relearn everything. So I took for granted how hard origination was, and had to get a loan from, when you're staring at something that you haven't done in 16 years, how to get it done with no help and no assistance and no staff at that time. But we did it. I wanted to relearn every step of the business, and it took a little longer than I'd like. But yeah, I think with Equity Home Mortgage, for us, we want to we relearn the origination business. We kind of after 6 months of it, we said, we really like what we're doing. Actually, this is fun. Yeah. Granted, making way less now than we did in the past, or at least for me, but the learning experience is worth it. So that part of it's great. We really, relearn that, but you're building something from scratch. So if it's our own capital, we're building the company and learning the process and building up our processes. That's what it's going to take. Any founder, any company that has, founders that are working in the business, that's what it takes. You kind of take your lumps, you learn it, you build a process, and you bring great people on. And that's where we're at now. We're learning that process. We want to bring people on and then make a decision to be nimble on where we're going to be, whether that's the wholesale channel, which we love, especially right now. And then are we going to kind of take this knowledge that we have and maybe build something special in that channel for the people that are doing what we're doing right now?
Interesting. So, it's to just think about actually, where you've come from, where you are today, and thinking about actually going back to that just the mortgage guy, moniker, tagline, whatever you want to call it. It almost makes me feel like you, and tell me if I'm wrong, that you love the business, like you get a lot of satisfaction over helping individuals.
Yeah, I think that's the part that I was surprised how much I was going to enjoy, that I enjoy that part of it, right? Like I thought maybe it'd be like you learn it, but then you're giving it to someone else to do and do certain things. And as you're kind of getting into it, you're like, oh, wait a second. Like, I don't know, if I wake up and the 10-year moves 5 basis points, I don't have to like have incredible anxiety all day. Like I don't have to worry about a $3 billion pipeline that I'm hedging or worry about, an audit from a company or like something outside of a small state audit that we get, but like you don't have to worry about these larger things that you deal with as a big company. So that part is like refreshing and nice. And that is the part of the just the mortgage guy kind of tagline of just being just a mortgage person here. Now, is my background, what I believe my industry knowledge is being utilized to its fullest right now at the moment? No. Yeah. But the part I was lacking the most, and what made me a good executive, at least in my eyes, or what I thought, is knowing that front end and tying it into the back end. And now we're doing that. Getting heads and how many people can talk about, the Jones application, submitting it through the online application, going to a lender, getting it approved, clearing the conditions, and then I know what they're doing with that loan. They're going to take it, put on their warehouse line. They're going to go ahead and take out their trade. They're going to go ahead and deliver it into security. They're going to do this part of it, split out the servicing, keep the servicing. The REIT's going to buy some of the servicing value, give them some cash. Like I've been through that, so I understand that part of it. So on our side, I think from what we see in the business, I think the company itself and what we're doing, like that front end is the most important piece, and a ton of the executives have missed out that. So that's what I'm trying to do here, and liking it so much that we're still doing it.
So, and by the way, Mike Kelleher just commented.
Oh, nice.
Fellow Clubhouse.
Mobile patio. What's going on, Michael?
So if anyone actually is on here, if you are actively, using Clubhouse, just throw a hashtag, Clubhouse, hashtag Clubhouse. Just curious actually who on here is actually using Clubhouse. So just hit us with a hashtag Clubhouse if you are using Clubhouse. So all right. So here you are. You have actually this passion for the borrower. You see actually the opportunity to right now understand the process and really be able to deliver the most value by knowing what it's like to go through the process. Know what it's like to explain to the borrower if somehow their lead gets bought as a trigger lead, and how you explain actually the 17 calls that they just got, and go through that, all the things that only an actual live originator would go through.
Yep.
So you take those. Yeah. Sorry.
Go ahead. No, go ahead.
So you take those things, these learning experiences, and then in 4 or 5 years, what does what does it look like then? Like what at that point, equity home mortgage is, what's the vision in 5 years?
Yeah, like any mortgage company, no clue, right? Anyone who says it's different, you don't know, right? So on our side, it's about finding the right path and being able to be nimble to go down that path. I love the origination piece. We'll never stop some semblance of origination. Like that is something that either we're going to do it or have people that bring loans to us. Like that is it. Like that's where we want to be no matter what. And kind of going back one step on this and talking about kind of the executives and other folks that are running the companies, I strongly suggest taking a ride. I've talked about it on LinkedIn, like take a ride as a customer. And that's, we talked about tactics that we've done. How many times has a CEO maybe that's been, is 11 layers removed from the front lines, like, and that's probably a small company, these days, especially with margins where they were. But, how many times have they taken a ride, both as a customer and as an employee? And I think that's where the difference lies in kind of where the world is going to be going and where the mortgage business is going. Because a lot of times people are, they're ignorant to the fact that their systems work and everything is fantastic. Meanwhile, if you took a ride, you go, holy cow, that's inefficient. And that's something we did at AFR, something we did at DiTech. It's one of those things that the team would have to do, and myself included, which is sit down, take an app, see what happens, see what automated emails go, see what happens in your application. How does it look? Is it aesthetically pleasing? Is it someone you want to do business with? Does it look smooth? Is the process simple? You have to take a ride. If you don't take a ride, how can you ever fix those things? I'm not saying you need to know how to do every single thing. You simply need to take a ride and understand what a customer experience is. You could certainly be a customer, and you could certainly be a team member and an employee by sitting down at their desk and watching keystrokes. How long does it take you to do a file? And we recognized at both companies that underwriters do a ton of data entry with the highest paid employee. Well, why would they do data entry at the highest paid employee? Why are they looking at something and typing it into another screen that can be easily automated? And how do we get someone else to do that for them, and so they make a decision? So that's the kind of thing that for us, we've gotten the knowledge base now. We have this, and now we're making our choices on how we're going to grow and where this company is going to be in the future. And I'm definitely excited about it. But I wish I could say, hey, correspondent is the place to be, or wholesale is the way to be, or that's it. You just don't know at this very moment. If origination's your focus, you have to be nimble to find where the best opportunity is. And right now, wholesale is fantastic because I'm taking very limited origination risk. I'm taking a lot of the kind of regulatory risk by being a lender out of play. And because there's a price war, I'm getting some of the best pricing out on the planet. So I'm not going to deviate from that right now.
Yeah.
But we're prepared to kind of either enter that channel or enter another channel should that change. But right now it's fantastic.
And the technology too. I mean, so like not only actually are you getting
for a loan officer is good.
Yeah. So like you're getting amazing pricing, so besides actually being a rate war, price war, there's also a technology war. They're saying, well, we're going to give you this, and we're going to give you this marketing portal, and we're going to give you actually all these tools, and you see actually that happening too. It makes it very difficult to kind of stay away from, or to ignore actually, the value of being actually in the wholesale channel and being a mortgage broker, especially since you're a startup firm. Yes, you are just a mortgage guy with tons of experience. You started out actually in February with a blinking cursor and no loans in.
Yeah, so it was fun because I probably wouldn't have said that about the wholesale side when nobody knew how to even price a loan for like a month, right? You were like, "What do you do?" That's the way it worked. You couldn't even get a hedge out. I was hearing some incredible stories, nightmares actually, from guys on the desk. And a year and change ago, we did a kind of a talk online for a trade association, and we went through it, and I was like, "You guys don't understand. Like, this is way worse 2008. What was happening? It's just chaos. You can't even get a bid for the stuff that you would normally deem as like cash. But yeah, I think, for the wholesale channel, pricing is fantastic. The tech is amazing. And we built incredible platforms at both companies that I was at. But the amount of money that we spent, right? The amount of money that, especially at AFR, building out this stuff and amazing tools, we built a consumer direct platform in eLend. Like, we had to build this stuff from scratch. We built it off the backbone of Ellie Mae, and it's very difficult. It was just tough and super, super expensive. I'm not going to say the numbers, but it was like big numbers, right? And if you turn around and think about today, the things that cost us incredible amounts of money, as an independent originator, I can get a really good tech stack for, they sass you to death because you're just getting all these subscriptions. But, we're talking $700-800 a month in total for like an overall origination tech stack for somebody. Like, that's not like and I have all the tools and the amazing tools that give an incredible customer experience. I can do that, and we utilize our portals. And then obviously our lenders have a ton of different tools and opportunities to use. I probably use 10% of what's available to me from my lenders. We like to have our full control of that portion and the customer interaction. I like to have that control. Yeah. We want to make sure of that. But the cost has come down so much, and that's the one space in our industry. I think a lot of people, we focus so much about, like a borrower providing you a PDF pay stub in our industry. Like, oh wait, but it takes a borrower like a minute to get their documents to you, like literally a minute. It's that manufacturing. Once you get the PDF and get the information, we spent so much time and money to have that automated and have that come in. And yeah, it's great when it works, but you're not getting that much speed improvement by a borrower providing, because someone who knows what they're doing on the computer is going to take 2 seconds to get you what you need. It's that manufacturing process that I think people didn't focus enough on. But we have that now with some lenders, and that competition is fun. Like, I like when I get engagement from executives at some of the major wholesale lenders that do want to hear about what's flawed in their portfolio, in their process, or what's flawed in their technology. And we do have that. And there's some good players out there that are listening and willing to invest. And then there's others that are just saying, it works. It works good enough.
So listen, you've been very vocal on the UWM the situation where they've kind of said, actually, if you're going to use us, you can't use Quicken Rocket Pro TPO. I don't know if you've publicly said actually what your decision is. I feel like actually I like in a lot of cases, like it's almost like you can't say who you voted for. Like no one actually wants to admit.
Oh, I could say it's pretty easy. It wasn't a tough decision. And I didn't want to make one. Right, I was very vocal on that. I did not want to make one, and we went with UWM. It was something that we did. It was for the purchase market. Did I like what they did? Absolutely not. I actually thought it was bad for the industry. But I understood it. I just didn't understand the timing of it and kind of maybe the motives, because you kind of, if you look at it and you know the whole picture and you kind of look at exactly what happened and the way it went down and the timing of it and the kind of back and forth and throwing in this other company in the middle of it, like obviously there's more going on than just protection of the wholesale channel, right?
Yeah.
There is nobody better than UWM in the channel.
Yeah.
That's it. That's a fact, right? There's nothing to say. I have purchased, we're dealing with it. And if I'm putting my family through a loan and we want to close and we're buying a house, that's where I'm going. And that's what the choice was. Now, how do I feel about Rocket? I thought they were a great partner. We utilized them as well. Do I think the right approach is being made on how they are kind of in the wholesale business? No. I think we went the opposite direction. I think whatever just happened is going to accelerate their hope to terminate that middle person, where they just started to get a taste of being able to grow share in that channel, invest in that channel, and really find a way to get the purchase market going, because that's something they failed at for so long. So instead of spending $17 bajillion on Super Bowl ads and everything to get people to say push button, get a mortgage for a purchase, well, how come their purchase volume was 7 and 8% and even less, over, in February? Well, that means it wasn't working. You know what was working? The TPO channel.
Wow.
And that last mile origination. So you had an opportunity there. And I think Quicken faltered a little bit too in how they responded to this. They could have easily had, instead of putting the person who's in charge of TPO out and talking about what's going on, they could have put their CEO out and immediately denounced the claim and said, we're here to back the wholesale mortgage brokers. And we think it's a great way to get business in, and it's how we're going to crack the purchase market. It would have been received differently than just kind of getting the person running wholesale out, talking about it a couple times, and then finally, like a week and change later, hearing the CEO talk about it.
Yeah, no, I hear what you're saying. It felt like it was a little bit of an afterthought, and it's I understand where you're coming from. I mean, it's unfortunate to see actually that I know a lot of people actually who are Rocket Pro TPO brokers, and they just love them, and they were felt, they were saddened that they had to make a choice between the two, and they just felt pressured. But some of them, like you, actually went the UWM route. Some went Rocket Pro TPO.
I think the how it was approached, and I wasn't happy with how UWM kind of dealt with it or did what they did. However, they were open. They gave dates and deadlines and said, this is how it's going to work. I don't like the rules. They were made for me. I can choose to abide by them or not. That I respected. And I respected the decision for the business that they were building and what they've done. Because you can't, like Quicken rode the coattails of Rocket's, I mean, of a UWM's expansion in that
whole
business.
industry. The whole industry did.
Exactly. So UW did all the heavy lifting, and then someone jumps in and gains so much share. Like, yeah, I get it. Protect your business. Like I get that part of it. I don't like it because I'm using both, but I understand. Now the response on what happened to those that chose UWM from Quicken was something that I didn't like, right? And that's something that I thought, at least if they said, hey, this is how it's going to work, this is how we're going to do it, we're taking the high road and close out your loans, but they were working on the loans. They, middle of the night, shut off all access to their main communication portal. They made it very difficult to get loans get done. And that happened in the middle of, woke up, in the afternoon, it was working and everything is normal. And we're trying to get these loans closed. And then the morning you wake up and you don't have access to it and have to go through jumping through hoops, and you can't utilize some of the perks that you had as a company, which I understand taking away, but no notice and taking away didn't hurt us. It hurt the borrowers. So that was something that, like UWM's decisions and timing and what they had, you made choices and you kind of can factor that in. These people had already been in the pipeline and will be affected based on pricing adjustments and other things and extension fees that you did not kind of forewarn them about, that they are getting hit with today. And that's true costs to the customer, where you're not, this isn't like a made up thing of, oh, I could have sold it here or brought it over here. That actually happened and costs were incurred.
Yeah. All right, we're gonna wrap up. I got Michael actually just of course he's always got these long thought-provoking questions that he asks. So how much does a wholesale company virtues and beliefs and how they lend themselves on social media? It's a great topic for brokers. Home feed. What does a home feed look like? The wholesale company. So I think he's trying to say, how do wholesale lenders tell their story and talk about their virtue and belief? And I think actually to Michael's point, like, what inspires you to look at a new wholesale lender? So obviously we know you're doing business with UWM. We know you're not doing business with certain companies, but what companies what does it take for you and Sean to say, hey, we should consider working with a new wholesale lender?
Yeah. So it's funny because we don't want much. Like, the more things that someone's giving me in bells and whistles of like, use my app and use my marketing tools and use this, is like, I wish you spent that money and just gave it to me a price and a better process. Right. Like, I don't, I'm glad you can make me flyers. Like, I'm out. Like, I can make my own flyers. Give me a better price. Don't need the staff for that. I prefer, like I said, that for me, for our borrowers, price matters a lot, right? In the wholesale channel, I have to provide a bunch of offers and find out what's best for my customers, and my LOs have to do what's best for the customer. So we like to have a good price. It doesn't have to be the best price; it has to be a good price. Then we have to have smooth, I would say, kind of on-demand disclosures. Like, those are the things, like to send it in and wait 48 hours to get disclosures out. And to have that in and have to wait, and our borrowers are sitting there waiting. Like, that part it boggles my mind that we're at this stage of the game in the business, and you have a huge percentage of our lenders that can't automate the disclosure process or give us control and be on the hook for it, but just give us control over the disclosures. And very few do that. And then, for us, the kind of interaction with a system and interaction with a portal is about speed and ease. A lot of the companies that are out there utilize a portal and technology that's just slower in nature, and they're usually using one giant company because that's the spiral of death. And we get a lot of that out there, and it's really tough to work with. And then your CD process, that's what matters. What does that CD and closing process look like? And that's what we'll look at. If you have the best price, but your operations and your process is a disaster, we're not going to sign up with you. Like, we don't want you on the roster. We'll never need that business. I'd rather just not do the loan than give myself the anxiety of not delivering for somebody. So for that, it's very simple. If you just give those three things, we're in, and that's what we want. And we want the ease of use and the ease of process. And maybe I'm going to say this and it'll be bad, but like the account executive, that kind of thing, that relationship, it isn't there anymore for me. I need to call and have someone. If it's a desk, I like to have one assigned person. That's great. But like we would love to have, a bunch of people you can talk to and communicate with, that when you call in, you're getting like a whole, platform. You're not getting a guy. When your whole process is reliant, you see a lot of these posts online and Facebook groups with brokers, you're like, oh, my AE's the best. He gets everything done. The more important that person is to get things done in your operations process, the worse your operations process is. That's it.
Yep, that makes sense. So you want actually a wholesale lender that can provide a predictable experience, call center environment. You don't necessarily want an account executive who's going to come out to your office next Tuesday, take you golfing.
Some of the best guys I've ever been around in terms of account executives, they did one thing, and that's what everybody says. They picked up the phone, right? They answered. When you were calling and you needed it, they picked it up, and that's what matters in that communication piece. And there isn't much value these days in bringing donuts because I'm working out of my house. So that part of it is certainly, you don't need donuts. We don't need the coffees. What we need is someone to pick up the phone when there's a problem and can guide us. They don't have to fix the problem. They can just guide us where it is. And that is the role of an account executive / account manager, in my eyes, and what we want for our company.
And have less of those problems to begin with, and then no one actually needs to have. That's like having those.
No, I think, listen, AE is very important. Having a single point of contact is very important in our business. I think it's important that role is there. How some of them or how some companies treat it in a regional thing, and that it matters where they are, and they have to go out and visit and do this stuff. I don't see as much value in there. The more that person's out and not able to answer their phone and help if needed, like that, then they're not doing their job function for that role for me, unless they have a really amazing operations staff and everything gets done no matter what, then maybe it's different. But that's the way we see it. And we certainly appreciate our account executives that we have. And some are, like I said, fit the mold to that, and some don't. and the processes between those companies certainly are reflective of it.
That's awesome. Rob, great hanging out with you today. Really, really appreciate it. I love actually, the stuff that you share on Clubhouse. I mean, it's really just awesome. And I'm just going to throw Rob's socials up here. Follow him on Instagram, Facebook, and Clubhouse. If you're not on Clubhouse, contact me, or contact Rob.
Yeah, I have some invites. For sure.
We both got invites. It is cool. It's just, it's something I think actually Clubhouse is only possible to be like it is because of the pandemic, because people are so thirsty for interaction face to face. And this is the second best thing to face interactions. But you're doing an unbelievable job, with your weekly show. Wednesdays it's like at 10 o'clock, 8:30.
It goes forever. So it's Wednesdays, 8:30. We don't have one tonight because my co-host is gone, and we have something that came up tonight. But next week we're back. It's the same old stuff. We always start with rates. That's my background. So we talk about rates, what's happening with rates. We usually have some great guests that pop on stage, and people from Housing Wire and other places too that jump in, and you're always on there, which is fantastic, asking great questions. So, but we'll run from 8:30, and if it's anytime you log on the Clubhouse, folks, is just an audio app, right? It's just basically like a live podcast app that is for only Apple users now, but is expanding, and it's just a really cool audio only. Why I like it is I don't have to actually put on a collared shirt because I'm interviewing on video here. I can be in my pajamas, my t-shirt, whatever it is, glass of wine, and we can just go on mortgage rants. And usually they end up going pretty late. Sometimes, one time it was like 1 o'clock in the morning. We were still talking about, we had some folks from Treasury on, we had some folks that, that were kind of directly involved in what was happening in early stages of the pandemic, people that were involved in the crisis. Like it's been crazy. CEOs of companies, we've had a lot of great people just jump on. It's not, there's always a little docket. We have rates. We'll talk about a topic or two, and then we just let it fly and see where the conversation takes us.
It's raw. I mean, this is not, by the way, you can't put this on speakerphone actually with your kids around. Like people are getting raw, and they're sharing, actually, they're sharing their wounds, they're sharing their concerns. And you have C-suite executives that are talking, without a filter, without legal departments and marketing departments saying, let's, before you go out there, make sure you hit these bullet points and make sure you don't talk about these things. But you have people just sharing it raw, and, Rob, you have an uncanny ability to kind of, inspire people to kind of get it out there, keep the room going, actually, kind of level, because it gets pretty crazy as the people in the room know, but,
Exactly.
Kind of keep it even keeled and interesting. It's had me actually past 12 o'clock, a couple of times at least. So
yeah, it's been fun.
So much. Thank you for all you do there. And thank you for watching another week of Mortgage Leadership Outlook. We come to you every Wednesday at 1 p.m. Pacific, 4 p.m. East Coast time. We are also now a podcast, so you can go find us on your favorite podcasting platform, whether it's Apple, whether it's Google, whatever you're using. Go out there and search Mortgage Leadership Outlook. You'll be able to find, subscribe, and give us good ratings, maybe. So
hit that like button. That's it.
Yeah. All right, everyone. Enjoy the rest of your Wednesday and hope you're having a great April. Take care.
Great. Thanks, Andrew.